Every bubble feels obvious, but only after it pops. While it's inflating, the smartest people in the room are buying. Banks, hedge funds, your neighbor who suddenly won't stop talking about it. And almost nobody sells in time. To understand why, you have to understand what a bubble actually is. Because it's not what most people think. A bubble isn't just a price going up. Prices go up all the time. A bubble is when the price of something detaches completely from what it's actually worth and keeps climbing anyway, powered by one thing: the belief that someone else will pay even more tomorrow. That's the engine, not value. Belief. Take a step back to 1637, the Netherlands. A single tulip bulb, a flower, sold for more than a skilled craftsman earned in a decade. People mortgaged their houses to buy bulbs they planned to flip in weeks. Then one morning, buyers didn't show up. Within days, those same bulbs were worth almost nothing. Nobody's house got more valuable. Nobody's flower changed. Only the belief disappeared. And when belief was the only thing holding the price up, the price had nowhere to go but down. Now here's the part that makes bubbles so dangerous. They all follow the same shape, almost like a script. It starts quietly. A new technology, a new asset, a real reason for prices to rise. The internet in the late 1990s was real. Houses are real. There's always a genuine story at the bottom. That's stage one, and the people who buy here usually do fine. Stage two, the story spreads. Prices rise, early buyers get rich, and getting rich attracts attention. Now money floods in, not because people understand the asset, but because they see other people making money. This is where the price starts pulling away from reality. Stage 3 is euphoria. The price isn't connected to anything anymore. "This time is different" becomes the most expensive sentence in finance. During the dot-com boom, companies with no profit, sometimes no product, were worth billions. From 1995 to its peak in March 2000, the Nasdaq rose about 400%. People quit their jobs to trade full-time. Taxi drivers gave stock tips. When the people with the least information are the most confident, you're near the top. And then stage 4. Something small breaks the spell. Not always a crash, sometimes just a pause. A moment where buyers hesitate. But in a bubble, hesitation is fatal, because the whole thing was built on the belief that prices only go up. The second that belief cracks, everyone reaches for the exit at the same time. From its 2000 peak, the Nasdaq fell about 78% over the next 2 years. Trillions of dollars in value, gone. Here's the comparison that should stick with you. In a normal market, price follows value with a delay. In a bubble, value gets ignored, and price follows emotion. One is anchored to something real. The other is anchored to a crowd, and crowds turn fast. So why do smart people keep falling for it? Because while the bubble is inflating, getting in is the rational move. If the price is climbing 30% a year, sitting out feels like losing money. The danger isn't that people don't see the risk. It's that the reward for ignoring it keeps growing right up until the moment it doesn't. There's a name economists use: greater fool theory. You can knowingly buy something overpriced as long as you believe a greater fool will buy it from you later. The plan works perfectly, until you're the last fool in line. And someone always is. This is the hidden mechanic. A bubble isn't an accident or a mistake by stupid people. It's a perfectly logical chain of individually reasonable decisions that adds up to collective madness. Everyone's trying to time their exit. Almost nobody can. The same pattern has repeated for nearly 400 years. Tulips, railroads, dot-coms, housing in 2008. Different assets, identical psychology. The price tag changes. The story stays exactly the same. If you want more breakdowns like this, the mechanics nobody explains until it's too late, subscribe. There's a lot happening beneath the money, and it's worth seeing clearly.